Hi, welcome back to this my fourth data update for 2024. In my second update, I talked about how equity markets performed in 2023. They rebounded partly because the market and the economy beat expectations and inflation stayed under control. In my third data update, I looked at the bond market, at interest rates, at not just in the US but across the world, as well as at corporate borrowing rates and default spreads. In this session, I want to talk about the final piece of this puzzle, which is risk and how it varies across sectors and geographies, and how there are different measures of risk and why they might give you different answers as you look across companies. Now, it goes without saying there are wide variations across companies and countries, and I want to use this session to update what those numbers look like in 2023 and how they play out in hurdle rates leading into 2024. Let's go back to a fundamental question. For 7 decades in finance, we have been a little obsessed about risk. And I think while we've spent a great deal of time, and finance deserves some credit for how much emphasis it's put on risk, there are some mistakes we made in how we've thought about risk and played it through. First, I think we put far too much emphasis in finance on market price-based measures of risk. In other words, standard deviation, volatility, or even if you've taken a finance class, a beta, all price-based measures. Second, I think in our deal to put numbers on risk, we sometimes forget that at its core, risk is more about that feeling in the pit of your stomach, when the biggest holding in your portfolio is melting down every moment. It's an emotional and physical reaction as much as it's a financial reaction, and we've somehow lost that connection. And thirdly, by making investing into a choice between good, which is expected return, and bad, which is risk. In fact, much of what we know in finance was built around what's called the mean variance theory, where mean is good and variance is bad. We've labeled risk, even though we might not have meant it, as a bad thing. And when you label something as a bad thing, the message you're sending to investors, to companies, is you need to reduce your exposure to it. So to kind of counter the kind of mistakes finance has made in the last 7 decades, I'm going to start with the definition of risk that I use in my classes as my starting point. It is the Chinese symbol for crisis or big risk. I'll be quite honest, every time I put the symbol up, I hear back from native Chinese speakers who tell me I've got the symbol wrong, and it's entirely possible I've still got it wrong. But I think I'm pretty close to the right symbol. And the Chinese symbol for crisis is a combination of 2 symbols: danger plus opportunity. That is the perfect definition of risk because it locks them at the hip. If you want one, you got to live with the other. And you know which one you want, right? We all want opportunity, and this particular definition reminds you that if you want opportunity, you got to be willing to live with danger. Think of how many scams and mistakes in investing would be avoided if we remembered this linkage. Now you take Bernie Madoff. How did he succeed? Because he told people they could make 3% more than the risk-free rate without taking risk. These were bright people, smart people, wealthy people, and they fell for it. The other advantage of using this Chinese symbol for risk is it removes the negativity associated with risk, right? Because it says, look, we take risk because we want opportunity. We expose ourselves to danger because we want opportunity. And one way to think about risk and return models in finance is you're trying to measure the danger in an investment not because you want to avoid the danger, but because you want to ask a follow-up question. Am I getting enough opportunity to compensate me for this danger exposure? So with that philosophical lead-in, let's talk about more pragmatic questions. When I sit down to value a company, I make a list of every conceivable risk I see this company facing. You know what? It's a long list. And when you look at that list, it's easy to feel overwhelmed. And often, when you look at analysts and investors looking at companies, they tend to get overwhelmed because there are so many different risks out there. So one of the first things I do is I take that risk, that long list, and put it into buckets. You say, what are those buckets you're talking about? The first 2 sets of buckets are estimation risk and economic risk buckets. What goes in the economic risk bucket? These are risks that come from things happening that are out of your control. It could be related to the economy, related to the company, the competition, the sector. That's economic risk. What's estimation risk? These are risks that arise because you haven't done your homework well enough. The reason I separate the two is doing more work, as collecting more data will reduce, perhaps even eliminate estimation risk, but there's relatively little you can do about economic risk. No matter how much you do your homework, those risks are still going to remain. The second categorization I use for risk is micro versus macro risk. What's micro risk? These are risks related to the company, its management, its products, risks specific to the company. Macro risks are risks from the interest rates, inflation, whether the economy is doing well or badly. You're saying, why bother? When you're looking at a company which is owned by diversified investors, and a vast majority of publicly traded companies are, you can argue that micro risks will get averaged out in portfolios. And it's just a pure statistical argument, the law of large numbers. For every company that does better than expected on a micro component, there'll be another company that does worse than expected. Things average out. So across a diversified portfolio, micro risk will disappear, but macro risk will remain. Consequently, when you divide risk into micro and macro risk, you're trying to figure out which risk to bring into your discount rate. And for companies with diversified investors, it's only the macro risks that show up. And thirdly, risk can be continuous risks or discrete risks. Continuous risks are risks you're exposed to every moment of every day. As an example, a US company with European operations will see its value change every moment of every day as the euro-dollar exchange rate changes. In contrast, if you're a US company with operations in a country with fixed exchange rates, you will notice no risk while the rate gets fixed, but there will be a time where there will be a devaluation, at which point you might lose 60% of your value. That's a discrete risk. Finance has been very good about coming up with tools to deal with continuous risk. But discrete risk, we still wave our hands around. We try to insure ourselves against it, but we're not good at bringing it into financial analysis. Now you might ask, why bother? Why break risk down into these buckets? There are three advantages to doing this. The first is, one of the challenges you face as an analyst, especially in the world we live in now, where data is so plentiful and you can read other people's research, is it becomes easy to fall into a trap of saying, let me do more homework, let me collect more data, I'm not ready to make a decision yet. And understanding that most of the risks you face in analysis are economic risks will mean that you recognize there's a point where you've got to stop and say, I've done everything I can, and even though I feel incomplete, I still feel uncertain, I have to make a decision. Knowing when to stop digging, at least in terms of data and analysis, is a key step in being able to decide based on the data. Second, on the discount rate front, I've often argued that analysts seem to view discount rates as receptacles for their hopes and fears. What I mean by that is analysts looking at companies try to adjust the discount rate for every conceivable thing they worry about. Many of those things are micro, company specific. And as I said earlier, if your investors are diversified, I'm not saying you shouldn't think about that risk, but you shouldn't be trying to bring it into the discount rate. And thirdly, one of the tools you'll find useful for dealing with discrete risk is decision trees, probabilistic tools. And I'm going to argue that you should take that opportunity to open up your statistics book, because statistics can be of great help, especially again in a world with a lot of data pulling you in different directions. I think we need to use more probabilistic and statistical tools. So let's talk about where finance has arrived over the last 70 years in terms of assessing risk. In fact, you can argue that modern finance as we know it was born that day when Harry Markowitz walked into a library as a PhD student and started thinking about what makes one company risky and another not. And he came to the realization that the risk of a company is not the risk of that company standing alone, but the risk that it adds to an investor's portfolio. And by itself, you're saying, what's the big deal? It changed the way we think about risk. Until Harry Markowitz, the way we thought about risk in companies is we thought about all of the risk in the company and we tried to bring it into the analysis. And the Markowitz insight was it's only the risk you cannot diversify away that matters. So you introduce the notion of a diversified investor and how that changes your perspective on risk. Now, after that input, people also started to realize that with market prices, you're getting a way of measuring some of that risk. It is true we went overboard in trusting market prices with efficient markets in the 60s, but even if you don't believe in efficient markets, you can't contest the idea that market prices convey information, albeit with noise. Diversified margin investor informative prices, those became the building blocks for the risk and return models that followed. Of course, the first and still the most sought after model, the most used model, was the capital asset pricing model. What did it do? By assuming away transactions costs and private information, it essentially meant that the marginal investor was not just diversified, he was supremely diversified. Held every single traded asset in the world in his or her portfolio, market portfolio, which meant that the risk you had to measure was the risk added to that market portfolio, and in the CAPM you measure that with the beta. Subsequent models, the arbitrage pricing model, the multi-factor model, all stayed true to the core theme, diversified investors, informative prices, but instead of having one beta, they might have 3 or 5 betas trying to capture multiple sources of market risk. But modern portfolio theory has brought us down the path where we measure risk as the risk added to a diversified portfolio, and we measure it using market prices. Now, those assumptions did give corporate finance some powerful tools, but it's exposed us to criticism from two groups of people. One group, especially old-time value investors, think it's, look at the fact that we're using market prices, and they take the view that market prices might not be good measures of risk. Their argument is you should be looking at earnings or something intrinsic to come up with risk. Good point, I agree. There are others who argue that this notion that the marginal investor is diversified, the investor setting prices is diversified, and work in some companies, but there are lots of companies where the marginal investor is not diversified, in which case we should be bringing in the rest of the risk into our risk measures. So financial risk and return models have been attacked on both fronts. Now, I could dismiss these criticisms, but there is a basis for them. And I think that there's a danger here that if you push back with the notion that you've got to use beta or betas, that many of these people are going to choose not to control for risk at all. So I'm going to argue that if you disagree with the modern portfolio theory-based risk and return models, you still have to measure risk, and I'll give you some choices. So if your disagreement is on the investors being, they're using price-based measures, there are alternatives to price-based measures. You could use accounting earnings, you could look at cost of debt, and you could try to come up with risk measures based on things that are not price-based. If you don't believe investors are diversified, then I'll give you ways of expanding your risk measures to bring in the rest of the risk, the total risk measures, which capture risk that you're throwing away right now. In other words, don't throw the baby out with the bathwater. You can discount, you can adjust for risk without believing any of the aspects that modern portfolio theory does, and we have the data to give you a starting point. So as I look at risk measures, I look at both traditional measures as well as these more non-traditional measures, and you can take your pick of what you prefer as your measure of risk. Now, my data universe includes every publicly traded stock in the world. And because they're publicly traded, they have market prices, so I can compute price-based risk measures easily. That said, a caveat. Even though these are publicly traded stocks, they come from countries with very, very different amounts of liquidity. There are markets in Africa where there's very light liquidity. I don't know how much the market price reflects value. And price-based measures are going to be affected by liquidity. So with those caveats in mind, I computed 3 price risk-based measures. First is a very simplistic measure of range. And here's what I did. I took the high price for the year. I took the low price for the year. So let's put some numbers in. 50 was your high price, 20 was your low price. I add the two numbers together, 50 plus 20. And then I take the difference between the two numbers. You see, what does that tell me? Basically, if you have a company which has a very tight range, let's say the high was 25 and the low was 20. Okay? High minus low will give you, so basically I'm taking I'm taking the sum of the high and the low prices and the difference in the high and the low prices, and the more variation there is in prices on a relative basis, the riskier you are as a company. So it's basically a measure of range that captures the fact that riskier stocks will have a much bigger range in prices. Simplistic, you're throwing away a lot of data, but it comes with the assumption that it comes with the advantage that there are no assumptions you're making the kinds of distributions stock prices fall into. The second and the more widely used measure is, of course, the standard deviation in stock prices. So what traders mean, they talk about volatility or say, no, essentially a measure of how much do stock prices move. There is an implicit assumption of symmetry here that might get you into trouble, but it's fairly easily computed. Note again, if you have an illiquid market, standard deviations are going to be lower in that market, even though it might be a very risky market. And the third price-based risk measure that I'm going to give you is beta. What does beta measure? Beta measures essentially the portion of your standard deviation that's driven by the market. So if you cut beta down to basics, it is that portion of the risk that you cannot diversify away. So let's see what these three measures of risk look like across sectors. Now, as you look across these risk measures across sectors, I've given you the high-low risk measure, the high price minus the low price divided by the sum of the two. So basically, again, the higher the number, the riskier the stock. Looking across all firms, my high-low risk measure is 0.30. You're saying, how do I know whether it's high or low? Compare across sectors, right? The riskiest sector, according to the high-low risk measure, is healthcare. In fact, healthcare scores highest on risk on both the high-low risk measure and the standard deviation stock prices. On the beta measure, technology is the highest. Utilities are the safest. And that kind of makes sense, right, on every single risk measure. So on a price-based risk measure, these are global companies broken down by sectors. You can see the variation in risk across different sectors. In the second table, I've looked at price-based risk measures across regions of the world. And here there are some surprising numbers, but much of the surprise comes from that liquidity question that I talked about. Take Eastern Europe and Russia. Now your gut tells you those were risky parts of the world. But you know what? On both a high-low risk measure and a standard deviation measure, they look pretty safe. But that safety is deceptive. It comes from the fact that trading volume is low in these markets. The riskiest parts of the world, and this might surprise you again, seem to be Australia and Canada. You're saying, what do they have? One of the problems when looking at regions is sometimes regions have sector concentrations. In Australia and Canada have a lot of natural resource and mining companies, and in 2023 at least, those groups of companies were volatile. So for better or worse, you're getting differences across regions on high-low risk measures and standard deviation. But in the beta measure, notice there isn't that much of a difference across regions. Now, some of you might be a little troubled. You're saying, how come the riskiest parts of the world don't have higher betas? Because beta was never meant to carry country risk. Now, later when we talk about equity risk premiums across countries, you'll see how riskier countries have higher risk premiums. But betas is scaled around 1 no matter what part of the world you're in. So not surprisingly, you're not seeing big differences in betas across regions. Finally, and this is a pet obsession of mine, for the last few years I've talked about the significance of a corporate life cycle. That companies are born, the teenage companies, and they become middle-aged, and then they age, and then they die. And I've argued that much of what we see in investing in corporate finance you can look at through an age, through the lens of age, of a corporate life cycle. So here's what I did. I took every publicly traded company and I broke it down by age, from youngest, that's the bottom decile, to oldest. And also, I set aside the roughly 2,600 companies where I could not compute a corporate age because it wasn't in the database. Because the database carried the founding date year for the company, and some companies didn't have it. Just focus on the companies where I was able to get data. As you go from youngest to oldest, on the high-low risk measure, older companies are less risky than younger companies. On standard deviation, older companies are less risky than younger companies. On betas, not so much, right? Now here again, there's a reason for that. Betas measure the risk you cannot diversify or risk added to a portfolio. What this table tells me that if you take an individual young company, it's going to look much riskier than an individual old company. As opposed to what? A portfolio of young companies was a portfolio of old companies. The law of large numbers is incredibly powerful. A lot of the risk you see in young companies is company-specific risk. So if you're an investor and you choose to invest in young companies, for God's sakes, don't put your money in 3 young companies, put them in 15. Let the law of large numbers work in your favor. So it's price-based risk. Let's move on to intrinsic risk measures. In intrinsic risk measures, rather than extract your measures of risk from market prices, where you worry about liquidity and market prices not being trustworthy, you look at intrinsic numbers. Like what? Very simplistic measure would be whether your company is making or losing money, with losing companies being riskier. It's 0-1. You either make money or lose money. If you want to dig a little deeper into earnings, you can look at the variability of earnings across time. The only problem is earnings by themselves as dollar values. That variability will be higher for high earnings companies and lower. So what I do to make them comparable is I compute what's called a coefficient of variation. Sounds fancy, but I take the standard deviation in the earnings and I divide it by the average earnings over the last 10 years. So essentially it gives me a scaled version of variability. It's a measure of earnings, it's a measure of risk. Higher risk going with higher variability in earnings. And finally, I know there are many intrinsic value investors who view debt as the primary reason for bigger risk. So I look at the debt load of companies. First, by looking at debt as a multiple of EBITDA. The higher that number, the riskier a company. And the second with interest coverage ratios, which is basically operating income divided by interest expense. And there you want the number to be higher to be a safe company, and lower numbers go with risky companies. So again, let's look at across sectors first. Let's start with the money losing group. And if you look across sectors, the sector, and I was a little surprised by this, the sector with the largest percentage of money losing companies is healthcare, followed by communication services at 40%. Followed by materials and communication services. Now, healthcare so if you define this as your measure of risk, healthcare is the riskiest sector, and the safest sector is utilities. If you look at the coefficient of variation in either operating income or net income, I've got a mislabeled here. One is operating income and the other is net income, right? So the first is operating income and the second is net income. You can basically see again that utilities have low variability in operating and net income. And if you look at energy, very high variability, the highest in fact in 2023, reflecting how much volatility there was in 2023 during the course of the year. And finally, when you look at debt load, ignore the financials, because that debt load really is meaningless, because debt to a financial is not a source of capital. But if you look at the rest of the sectors, real estate stands out as having the most debt as a multiple of EBITDA. But in terms of interest coverage ratios, you could actually argue that the riskiest group is utilities, because the interest coverage ratio is low, but that's a little deceptive because the earnings are so predictable. So clearly the debt load is kind of a mixed blessing. If nothing else, it tells me that debt load based measures of risk are going to be dicey, difficult to use. If you look across regions and again replace the second operating income with the net income, here's what you see. If the parts of the world with the highest percentage of money losing companies are Australia and Canada, again reflecting the sector bias towards commodity companies and natural resource companies. The UK and the US have a pretty high percentage. Almost half of UK companies are money losing and about 42%. The market with the lowest percentage of money losing companies is Japan, 14.8%. If you look at the coefficient of variation across parts of the world again, Japan scores pretty low. It's one of the lowest. So Japan is if you look in terms of purely intrinsic measures, Japan has some of the safest companies in the world in terms of earnings variability. In terms of debt load, if you look across regions, China has the highest debt load, $10 of debt for every dollar of EBITDA. And the part of the world which has the lowest borrowing tends to be Eastern Europe, $2.7. I guess, lenders are wary about lending to those companies. If you look at interest coverage ratios, remember there a low number is risky. Again, China is pretty low. So is India. So are India and small Asia. Asia has a significant amount of debt. Perhaps growth will rescue them from that debt load, but it's something to be aware of. Finally, I broke companies down into age deciles from youngest to oldest, and let's look at the statistics. And here, the statistics again make sense. As you go from younger to older, the percent of companies that are money losing goes from high to low. 57% of companies among the youngest decile are money losing. Only 15% of companies, which are the oldest companies, are money losing. If you look at coefficient of variation, again you see that same pattern. The youngest companies have the most volatile earnings. The oldest companies have the least volatile earnings. Debt load, though, it's a mixed blessing. It looks like, across the board there is significant debt as a multiple of EBITDA. But in terms of interest coverage ratios, the youngest companies are the riskiest, the most exposed. They have the lowest interest coverage ratios. So clearly, big differences across companies and geographies. But here I want to focus on one specific aspect of risk I haven't talked about, at least in depth yet. There are clearly differences across countries in terms of how much risk you're exposed to. If you ask me why, some of it comes from the political structure, right? Democracy. But ultimately, the reason political structure matters, it makes economic policy more volatile if you have a political structure that causes change. Second is corruption. Corruption acts as a hidden tax and essentially lowers your earnings as a company, affects your value, affects analysis. The third is war and violence. By creating a physical threat to your company and your personnel, you are in effect making your company less valuable, your projects less likely to succeed. Maybe you can try to insure them, but that becomes a cost. Then you got legal and property rights. After all, you run a business. Your value for that business or a project is heavily dependent on whether your rights are enforced. And in countries where legal and property rights are weakly enforced, you could argue that fewer projects are going to be taken and companies are going to be less valuable. Now, of course, you might ask, how do we measure this country risk? There are two ways you can do it. One is ratings agencies for a century now have been assigning sovereign ratings to countries, essentially measuring their default risk. There are about 150 countries with sovereign ratings. Unfortunately, from the perspective of equity valuation, a sovereign rating doesn't help me that much. So much of the last 3 decades, I've been using these sovereign ratings to come up with an equity risk premium for countries outside the US. So here's what I do, and I'll use the start of 2024 to illustrate how I'm getting equity risk premiums for other countries. I start with the US equity risk premium, the implied premium that I described in Data Update 2 from earlier this year, where I came up with the implied equity risk premium of 4.60% for the S&P 500. That's my first stop. Then I go collect the sovereign ratings for the 150 countries that either Moody's or S&P rate. For those countries that don't have ratings, and these are called frontier markets, countries like North Korea, Syria, Russia for the last year and a half, I look up what's called a political risk services score, a country risk score attached to countries. I'll talk a little bit about how I use that in a few minutes. For the countries that have ratings, I convert the rating into a default spread. In other words, every rating goes with the default spread. The lower your rating, the bigger the default spread. And those spreads were updated on January 1st, 2024. And here's the last step. I take that default spread. And here's the logic I use. That's the spread I'm charging for buying a bond. But if equities are more volatile, the equity risk premium should be higher. So I look up the standard deviation in a fund, an emerging market equity fund, and divide by the standard deviation in an emerging market government bond fund. I was lucky enough to find both traded. And in January 1st, 2024, equities had a volatility 1.34 times higher than government bonds. You're saying, how am I going to use that? If your default spread is 2%, I'm going to multiply it by 1.34. That gives me 2.68%. You add that to the 4.6%, your equity risk premium is going to be 7.28%. And I do this for every rated country. For those countries that don't have a rating, I use the PRS score. I look for other countries with similar PRS scores, and some of them have ratings, and I use the equity risk premiums of those countries. So enough said. Here's what the world looks like to me at the start of 2024. So at the top you have a heat map. Red is the riskiest countries, the highest equity risk premiums. Dark green are the safest countries, and you see the US, you see Canada, you see Australia, you see parts of Europe. Light green is pretty safe. You see China, in spite of all the talk of bad things happening there. Now Libya is a surprise, and part of the reason for that is Libya is not rated as a country, but it has a political risk score that is surprisingly high. That puts it in the safe category. Now this could be the rating services screwing up, but I've learned that if I start touching this data, changing the things I don't like, I'm going to get myself into trouble. So I'm going to leave it as is. So for better or worse, this is what equity risk premiums look like by country across the world. Now, incidentally, if you are from a country where I've given you a high equity risk premium, I apologize in advance, but rather than get mad at me, recognize that this is not a subjective judgment I'm making. I'm basing it on your sovereign rating, and you might believe your sovereign rating is too low. That ratings, Moody's has been unfair to you, but that's between you and Moody's, not between you and me. Now, these are the equity risk premiums I use in valuation in corporate finance. In corporate finance, I use them when I do project analysis. In what way? If I am a US company, Coca-Cola, and I'm starting a new project in Brazil, to estimate the hurdle rate for that project, even if I'm doing everything in dollars, I need a risk premium for Brazil. So for multinationals, this becomes a key ingredient in how you come up with hurdle rates for projects in different parts of the world. When I value companies, remember, companies might be incorporated in the US, or the UK, or Europe, but if they are multinationals, they get their revenues from all over the world. Their equity risk premiums should reflect where they do business, not where they're incorporated. I use this table to come up with the equity risk premiums by country. So that's the end game here. So let's see where we are. In my second data update, we talked about equity risk premiums. In my third data update, I updated the numbers on risk-free rates and default spreads. In this particular session, we talked about ways to adjust for risk. I talked about betas, but I also gave you alternatives. You're saying, why did we bother? Because all of these numbers go into a cost of capital. A cost of capital is a weighted average of your cost of equity and your cost of debt. Your cost of equity comes from the risk-free rate, the beta, and the equity risk premium. Your cost of debt comes from your risk-free rate and your default spread. So all of these numbers give you a cost of capital. You're saying, so why do you need a cost of capital? Because I've called this cost of capital the Swiss Army knife of finance, because it's everywhere. I teach a corporate finance class where I talk about how to manage businesses. Corporate finance becomes the hurdle rate you use to decide whether to take projects. It's an investment hurdle rate. In capital structure, it becomes your optimizing tool to decide the right mix of debt and equity. In dividend policy, it becomes the rate you use to decide whether you should be paying dividends or holding the cash in the company and reinvesting it. As outsiders, investors looking at the company, that same cost of capital for the company becomes the discount rate used to come up with an intrinsic value for the company. It's playing 15 different roles, and you need to be clear about where you're computing the cost of capital, where your computed cost of capital is going to play its role. So I brought all the numbers together at the start of 2024, and I computed the cost of capital for every publicly traded company globally. Then I put up a histogram. Nothing fancy, I'm just counting the number of companies with cost of capital in less than 6%, 6 to 6.5%. So the graph itself is US and global company, but I think the more informative the component of this graph is the table. Say global companies. The median cost of capital for a global company at the start of 2024 was 8.7%. Median cost of capital for US company was 7.9%. These are in US dollars. If you want to convert them to a different currency, just add the differential inflation. So if you want to do this in rupiah, and the Indonesian rupiah inflation rate is 2% higher than the US, just add 2% to 7.91%. And that'll give you a median cost of capital in rupiah terms. two things that should come out at you when you look at this graph. One is you can compare these numbers over time. Those numbers, 7.9 and 8.7%, are significantly lower than the cost of capital at the start of 2023. In fact, the cost of capital for global companies was close to 10%, for US companies 9%. You're saying, what happened? The risk-free rate actually stayed the same. So unlike the previous year where the risk-free rate changed, you can't blame the risk-free rate, but the price of risk came down dramatically for both equity and debt, and you see that play out as lower cost of capital. Cost of capital at the end of 2023 is significantly lower, 1 to 1.5% lower than the cost of capital at the start of 2023. But if you compare the cost of capital at the end of 2023 to the cost of capital at the start of 2022, that cost of capital was less than 6% for both US and global companies. Why? Because risk-free rates were low, 1.5%, and risk premiums are at historic lows. The bottom line is, if you're a company that's been using the same cost of capital for the last 5 years, what's wrong with you? You can't use some, things average out normalization argument, because that's like arguing a broken clock is right because it's right twice every day. Costs of capital are dynamic, they're shifting. It's your obligation as a company to have a dynamic way of capturing cost of capital. You're saying, but my projects are then going to go from good to bad. Hey, get used to it. That is the real world. Build in escape hatches into projects if things turn on you. Costs of capital are shifting in volatile numbers, and this graph hopefully brings that home. So as I summarize this entire session, it I think brings home the lesson that the only constant in markets is change. That things are going to change. You don't know which direction, but they're going to change. Now, if your question is, what can you do to prepare for that change? Be adaptable, rework your hurdle rates, build in escape hatches. Now, if your question is, if you complain about the fact that there's so much change, please stop. Remember the Chinese definition for risk? Danger plus opportunity. It's true there's a lot of danger. It makes you scared. You worry about the uncertainty. But with that danger comes opportunity. It's a feature, not a bug. And here's my advice to you. Build your skill set, build your competitive advantages on at least some of those dangers. Then seek those dangers out, because you're going to be better at taking on those dangers than the typical person in the market. Perhaps opportunity will come to you. I'm not suggesting this is easy or that the success is guaranteed, but if investing is a game of odds, this is how you shift the odds in your favor. I hope you found this session useful, and thank you very much for listening.